The psychology of money. Have you ever thought about why two people with the same pay can have such different financial outcomes? Why do we spend, save, and trade the way we do? What hidden factors affect our choices? We'll be going deep into the fascinating field of money psychology in this video. We'll be looking at how our thoughts, feelings, and habits affect our money in ways we don't always notice. Are you ready to learn the tips that could change the way you deal with money for good? Nobody is delusional. Let's face it, not all of us rely solely on spreadsheets to make financial decisions. Rather, we prepare them while having supper or a business meeting. These are the settings where our individual histories, our distinct worldviews, our egos and pride, marketing influences, and peculiar motivations all come together to create a narrative that resonates with us. We'll all take advantage of money in surprising ways, mostly because we're still getting to know this whole game. To me, anything that appears somewhat absurd may make perfect sense. But hey, nobody's going crazy. Everyone makes decisions that are shaped by their own experiences, and that, at the time, make perfect sense to them. Chance and danger. Have you ever considered the roles that risk and luck play in our financial success? Isn't it quite the game? The truth is that evaluating someone else's or our own financial achievement is never as simple as it may seem, because the outcome was more likely impacted by extreme luck or danger. The more extreme the outcome, the less likely you are to be able to apply its lessons to your own life. The key to overcoming failure is to set up your finances so that a poor choice here or a missed objective there won't bankrupt you and allow you to keep trying until the cards fall in your favor. Keeping track of funds can be challenging, particularly when the goal is always moving. Relatives shouldn't bring you down. Keep in mind that enough is not the same as too little. Remember, some things are just too valuable to take a chance on, no matter how big the payoff might be. The enchantment of combining. Compounding can be compared to a snowball. A little growth that keeps feeding future growth. It may begin modestly at first, but over time the outcomes might be so enormous that they appear nearly magical. Compounding isn't often our first idea. We ignore it in favor of finding alternative answers. It's not that we overanalyze, rather it's that we frequently neglect to stop and take into account the incredible potential of compounding. Assume for the moment that you begin saving $200 a month at an interest rate of 6% annually. By the time you become 60, you will have personally saved $96,000 if you begin saving at age 20. However, the power of compounding will have allowed your money to increase in value to almost $502,810. On the other hand, if you begin saving the same amount at age 40, you will have personally saved $48,000 by the time you are 60. However, since compounding takes less time to work its magic, your savings will only be worth about $70,400. The power of compounding is aptly illustrated by this example. The earlier you begin saving, the more time your money has to appreciate in value. The path from acquiring wealth to preserving it. Respect and dread, a reminder that things can change quickly, are needed to maintain wealth. It's about humility and acknowledging that good fortune plays a role in success, and that past triumphs don't guarantee future ones. Maximizing returns isn't the greatest method to make money. It's important to earn high returns throughout time, especially during challenging times. Conservatism involves avoiding risks. A margin of safety increases your chances of winning at a given risk level, keeping you in the game. The clever thing is that a greater safety net requires less advantage to win the race. Have a barbell personality, optimistic but aware of potential hurdles. There are many remarkable ways business and investing work. Long tails, the extremes of a distribution, are powerful in finance. This is where a few events explain most outcomes. Most publicly traded companies fail, a few succeed, and a few excel and earn most stock market returns. Thus, accepting that tails drive everything in business, investing, and finance makes it natural for things to go wrong, break, fail, and fall. The game includes everything. Being in charge of your life sparks joy and well-being more than any other objective life circumstance we've researched. Is there anything better than freedom? The amicable interpretation of the man-in-the-car dilemma. Isn't that a funny thing? We frequently see ourselves seeking wealth in an attempt to get the approval and admiration of others. The surprising thing is that we might not be impressing the exact people we wish to impress. No, it's not that they don't value wealth. Simply said, they're too preoccupied with utilizing our accomplishments to further their own aspirations for likability and admiration. It's something, is it not? Riches. It's what your eyes cannot see. Wealth is analogous to a treasure trove that is meticulously preserved for later use. It is not merely what you may purchase right now, rather, it is the promise that it holds. It gives you the adaptability to make decisions, the flexibility to be flexible, and the opportunity to develop your wealth so that you can later reward yourself with a significant purchase. Keep in mind that first impressions are not always accurate. Not only are there people who are unassuming yet have hidden wealth, But there are also others who are extravagant but are on the edge of experiencing financial ruin. Therefore, keep this in mind the next time you are assessing the accomplishments of another person or developing your own goals. For the purpose of accumulating wealth, the most important factor is to increase your savings rate. Income and investment returns are secondary factors. Also, what are you aware of? That is something that you have the ability to do. The gains that you produce from your assets can, in fact, make you wealthy. On the other hand, there is always a certain degree of uncertainty involved in the process of investing. The market will not always cooperate, and the approaches that are currently in use might not be able to continue indefinitely. Doesn't it feel like a little bit of a guessing game? When you learn to be satisfied with less money, there is a possibility that there will be a gap between what you have and what you desire. Here is a small thing you should know. It is akin to getting a raise in that it is less complicated and provides you with more control about the situation. You should think of your money as a personal safe harbor. There are always going to be unexpected twists and turns in life, but if you have been saving money, you will be prepared to deal with everything that comes your way. If you do not have control over your time, you are completely helpless in the face of any surprises life may throw at you. On the other hand, if you are willing to allow yourself some degree of flexibility, you can wait for those fantastic opportunities to come your way. It is comparable to a tax credit for savings that have not yet been incurred. Having the freedom to wait for the best opportunities in your profession and investments is something you can accomplish if you have that freedom. You'll have a better chance of acquiring new skills whenever they are required. You will not be required to seek competitors who have capabilities that are superior to your own. You are going to be given the opportunity to explore your passion and your area of expertise at your own pace. Choosing a strategy that makes sense is more reliable, and you can rest assured that it will serve you well in the long term. This is especially true with regard to the way in which you handle your finances. Those intelligent investors who continue to stick to their plans despite the fact that they are slightly flawed, the answer is yes, they do have a concealed weapon. Much of their success can be traced to the fact that they have been so committed to these strategies. Take into consideration the market's volatility as a useful toll gate rather than a terrifying fine. To encourage you to endure and let investment work its magic, this seemingly insignificant shift in perspective can go a long way toward achieving that goal. What is remarkable, in your opinion, is the fact that various investors can have different perspectives on the same situation. In all honesty, perception is the most important factor. In the event that investors have different goals and time horizons, which is something that is unavoidable across all asset classes, a sum that looks to be excessive to one person may appear to be completely reasonable to another. This occurred as a result of the fact that every investor takes into account a different set of factors. Think about the process by which bubbles are formed. It happens when the allure of profitable profits in a short amount of time is so strong that a significant amount of money is recruited. This causes investors to alter their focus from being primarily focused on the long term to being primarily focused on the short term. When bubbles reach this point, they have the potential to become extremely messy. Long-term investors who are normally engaged in a completely different game start to take their signals from those short-term traders at that moment. This is the point at which they change their strategy. If you're willing to try anything. Because of the nature of humans, we frequently have a tendency to believe in stories that are in accordance with our goals, even if those stories are not based in existence. One of the ways in which our minds generate narratives is demonstrated by the fact that we have a natural inclination to see what we want to see and to fill in gaps in our comprehension. This tendency can have a substantial impact on the decisions we make regarding our finances as well as our views of achievement. These topics are explored in great depth in the book, The Psychology of Money, which provides a comprehensive investigation into the ways in which our psychological biases and behaviors influence the decisions we make regarding our finances. The purpose of this study is to investigate the ways in which our perception of money is impacted by elements such as risk, luck, and the power of compounding. One of the most important lessons that it conveys is the significance of managing our conduct in order to achieve financial well-being, as opposed to solely concentrating on the accumulation of prosperity. It is emphasized throughout the book that to achieve financial success, it is not enough to simply make money. One must also maintain it through the disciplined practice of saving and investing. The mentality shift from pursuing riches to concentrating on techniques that protect and grow what we already have is encouraged as a result of this movement. This attitude is essential for achieving long-term success and stability in one's financial situation. When we have a better grasp of the psychological elements that influence our approach to money, we are able to make decisions that are more informed and build habits that are healthier for our finances. The book, The Psychology of Money, offers insightful knowledge on the ways in which our ideas and feelings influence our financial lives. This has the potential to assist us in navigating the complexity of money with a heightened awareness. At the end of the day, embracing a desire to investigate and comprehend these psychological factors can ultimately result in more efficient financial plans and a more profound appreciation of how we view success and riches. If you're ready to unlock more insights like these and transform your financial future, don't forget to hit that subscribe button and join our community. You won't want to miss what's coming next.